Hi, and welcome to Cash Kaw, the show where we talk about finance, accounting, investments, and many more. Join me as we travel to the big world of finance, one step at a time. Well, hello everybody. Good evening and welcome to Cash Kaw. It's me once again, Dharmaraj, and let's get into the episode. So today, I was having a conversation with this colleague of mine. It turned out to be a rather interesting one. We talked about something that's used very commonly in accounting and finance, in financials and all. So I thought, why not talk about it on Cash Kaw? So today, let's talk about accruals and deferrals. Now, accruals and deferrals, I consider them a very important, very key cornerstone of the accrual method of accounting, which you would remember from past episodes, especially the fantastic foursome of finance episodes. Now, these are usually governed by and regulated by something, depending on which country you're from, either the Generally Accepted Accounting Principles or GAAP, or the International Financial Reporting Standards or IFRS, or in Malaysia, the Malaysian Financial Reporting Standards or MFRS. These are all basically standards and governing sort of rules where financial standards are based off. So the objective of that is to make sure all your reporting, all your financials are standardized throughout, no matter what industry you are, and they have different standards for each industry, and to make sure everyone follows the same sort of standards, to make sure it's a regulated financial reporting that you're doing. So the accrual method, as opposed to the cash method, if you remember, is when you recognize revenue based on when you perform the work, and you recognize expenses when the expenses has been incurred. Now we'll go into a bit examples. I probably if you listen to my fantastic foursome of finance episode, some of the other ones, you remember the broken window example, where I talk a little bit about this. But if you haven't listened, let's talk about it now. So I'll give a different kind of examples as we go throughout the episode. Okay, so let's talk about accrued expenses and accrued revenue first. So now, let's say you have done some work. Okay, you've done some work. I'm a plumber. Let's be plumbers. So I'm a plumber, and I come and I fix your plumbing in your house. But I don't invoice you. I forget to invoice you. I only invoice you the next accounting period. Now, accounting period could be a month, it could be a quarter, it could even be a year. But I don't do it in that accounting period. So what I'll do is I'll recognize the work that I've done in your house, meaning to say that I will put a journal entry, or will perform a journal entry in my books to recognize the revenue from the work that I've done in your house, even though I haven't invoiced you yet. And the next month when it rolls around, I will invoice you for real, and it will set off against this accrual that I have done. Now, how it's set off and all is very usually some people use reversing journals, and they accrue and then it will reverse out and then you invoice it. It's sometimes also used to prompt you when you're doing accruals to invoice for that work done. But that's all nitty-gritty. That's all things you need to know if you're actually doing the journal entry. But right now we're not going to talk about that. We just want to understand the whole general concept of accruing and deferring your expenses and revenue. So that was an example of accrued revenue. Now, accrued expense is sort of the same thing. Let's say I was on the other end of the spectrum, I was the customer, and you came and fixed in the plumbing in my house, I would accrue the expenses even though I haven't received the invoice from you yet. This is done for a lot of reasons, but we'll go into that as we close off the episode. Now, let's talk about the flip side of that, the deferrals. Now, deferrals, to defer, the word defer means to push something or postpone something, right? So that's exactly what it means when you talk about deferred expenses or deferred revenue. So deferred, anything that's deferred, you push it. So for example, deferred revenue, let's say I am a plumber again, but I have now invoiced you. I've invoiced you and I've recognized the revenue. However, for some reason, I don't perform the work until the next accounting period, which is February. So what I do is I create a journal entry in my books in January to push the revenue from whatever I invoiced you to the next month. So I'll be pushed to the next month and then net off sort of the revenue that I've already recognized prematurely in this month. Which is why sometimes some people classify deferred revenue under the prepayments adjusting entry. Now the same thing is true for prepaid expense or deferred expenses, where you can defer your expense incurred. So let's say you have a house that is being built, and you defer your expenses according to the progress of the house. So maybe a house is a bad example because it's usually built for consumers, but you can replace it with a property, plant, or equipment, and you can sort of understand that, let's say you finish 10% of the expenses, but you've already paid for the whole property, plant, and equipment. So those will be under prepayments, but also can be categorized as a deferral. So you will push the expense portion throughout the construction of the house, so you don't incur it all in one month. This can also fall under the amortization and this kind of thing. So let's say you build a house build a piece of equipment for 10,000 and you pay upfront. You won't obviously recognize all the expenses in that month. You will spread it out over the useful life. But that's going into depreciation, which I've already talked about in another episode. Let's stay focused on deferrals and accruals. So we've understood that accruals and deferrals are making adjustments for things that that have either been done or not been done, depending on if it's a deferral or an accrual. If you accrue something, that means you're making adjustments for something to recognize the revenue in that month, even though you've not invoiced for it yet, or you've not received an invoice. And deferral is something you do when you've already invoiced or you've already received an invoice and you want to push the revenue forward, or you want to push the expense and spread it out longer over a period of time. What this essentially accomplishes is to meet the accrual basis of accounting's requirements and recognize expenses when they are incurred and recognize revenue when the work is done. So that's basically it. It's a very simple kind of concept. The nitty-gritty of it, the how they do it, and the methods they use in actual accounting systems and all are very different and very long, and we can talk about those for hours, but we're not going to, because this is meant to be a very fundamental thing. So as long as you understand the concept of deferrals and accruals, it's a key part of understanding your financial statements. You'll find a lot of these terms strewn sometimes across your annual reports, deferred revenue expenses, deferred accrued expenses. Sometimes you see them in annual reports from time to time. And when you're talking to your accountants and you're talking to your finance guys, they'll sometimes throw these kind of words at you. You need to understand what they mean and what the reason they're doing it for, and you're all good. So I think that's all for today. It's a very short and sweet episode. Once again, as always, please do drop your thoughts on any comments you have. Until next time, I thank you for your time, and may your assets ever outweigh your liabilities. This was Cash Kaw, and I wish you good night.